Let me chill. Let me not snap too much though. Feel me? Let me not snap too much, nigga. I was about to really get in my bag. Market maker models today. Market maker models. Chill. I look a little. I'm trying to let my shit grow out. Damn, that shit look bogus. Ugh. That shit look old bogus. Shit look like. Now my shit growing in though. Chill. Anyways, market maker models today. Let me show you guys the quick little dub I took today as well. So overall draw. Overall bias is bearish because we had this low below. Had this low below. Hold on, let me do something real quick. Don't mind me. Just give me 1 second. Damn. If I play this in the background the whole time, hopefully I don't get copyrighted. I don't give a fuck. I don't make no money off YouTube. Ta. Oh yeah, so the play today I took was this 3 minute before market open. I was done before the day started. Stupid adding. It's like, nah, 3 minute short right here. Overall draw was this low down here, even though obviously we just need a piece of the pie. We don't need the whole pie. Stupid adding. So we, on the 1 hour, so that was the draw. Saw that we're about to create this order block right here. And then we were respecting this fair value gap. And then we were also respecting this breaker block. You guys haven't learned that yet, but respecting this breaker block. So I was bearish, showing me bearish order flow. So I like this. And we also tapped into this 3 minute imbalance as well. So let me show you guys how I played it. Entered right here. And then I saw that ES, so let me show you guys. So my first target was here. But as soon as we swept this on NQ, we swept these lows on the ES. So I took out all my position at this low rather than this low, even though this is my draw. That was my TP. Took that out pretty fast. Closed there. And that was a trade for the day. But now let's get into market maker models, brother. Market maker models, brother. Ta. If you're not from Jersey, fuck off my like nah. I'm from New York, but I jack Jersey too a little bit. Let's go into market maker models. So market maker model is just a runoff of internal to external, external to internal. It's the same thing. Well, so what a market maker model is external to internal, internal to external. That's all it is. Like the video I did before, it is a run on a certain point of interest and then a reversal from that point of interest. So let's show you guys an example. So we have, let's say, high time frame, let's say equal highs up here, right? Equal highs. And then we also have some sort of liquid, let's say before this equal highs are ran, we left some sort of liquidity down here. So we have some sort of liquidity. See, it's just a significant low down here. or just the bottom of the market maker model, which you guys will understand in a second. Well, we'll say we left liquidity down here as well. Let's say we left LR. I'll put that out in a second. So boom. So we have our original consolidation. And then we have a move up. And then we have another move up. And we'll usually get some sort of form of consolidation again, and then we'll get a run on these equal highs or this liquidity point, the point of interest. And so once we run this liquidity point, which is the draw, this is the top or the bottom of the market maker model, as it could be vice versa, and this could be equal lows, and it could be coming down like this. But this is a market maker sell model. This is the top of the market maker sell model. So once we sweep this area, this is where the reversal point comes. So we get something like this, boom, another consolidation, and then we get a break of structure, boom, and then another form of consolidation, and then we eventually get a run to the original consolidation point or the liquidity resting below, whatever liquidity you wanna target. So this is what a typical market maker model looks like. So we have our consolidation areas, and it doesn't always typically have to look the exact same, but this is just a general framework for what a market maker sell model will look like. When I say POI, that just means point of interest, point that it wants to reverse / reversal point. And why do I say this is simply internal to external or external to internal? So view these equal highs that I marked out as external liquidity, right? So once we ran this external liquidity up here, we're going to be looking for some form of internal liquidity resting below, because we just ran this external. So all it's doing is it's running towards that external, then it's going to some sort of internal to then push back up and run external again. Because remember, price is always targeting external or internal. And it's always just going to be another market maker model, some form of a market maker model at some point. But as you could see, external, this is the external liquidity. And then the sell model, the sell side of the curve is running to some sort of internal liquidity. The fuck? Internal. External, internal. So we're drawing to some sort of internal, could be a fair value gap, could be a low within the fair value gap, but it's usually a fair value gap. So they'll be targeting some sort of like high time frame HTF, let's say fair value gap, just for the sake of example. So there'll be some sort of gap right here that it'll be targeting, that it wants to target after we ran this external liquidity, right? And all this does, it gives you a map, it gives you an idea of where the market is going to go, because a lot of this will be hindsight, unless as you get better, you'll be able to kind of call it out in before it actually happens. And the one thing you want to know, you more than likely only want to and will be able to catch one side of the market maker sell model or market maker buy model, or market maker model in general. You don't need to catch both sides of the model unless it's separate days, and of course you're trading a high time frame market maker model. But if it's a lower time frame, like the 15-minute, you don't need to catch both sides, because you don't know if you don't know where price is gonna go. It gives you an idea, right? Like it could give you, it's always gonna be a curve. And so the both sides of the curve, so this will be called, this side of the curve is called, in the case of a market maker sell model, the left side of the curve will be buy side of the curve, right? This is called buy side of the curve. buy side of the curve, and then there's of course the sell side of the curve, which is the sell model. Well, this whole thing is a sell model, but this is the sell side of the curve, because obviously sellers are making money on this side of the curve. Sell side of the curve. And in this case, you don't want to catch both sides. You just be comfortable with catching one side. Like this is a point of interest. So for example, how I would play this if I was trying to catch the sell side of the curve, I'd be like, okay, I'm gonna see the external liquidity get ran, and then I'm looking for something lower. I'm looking for some sort of internal liquidity. Let's say right here, there's equal lows right here, right? So we left equal lows down here. Let's say I'm in the market at this area right here. Let's say I'm trading at this time right here, 2:30, right? And I see that there's a fair value gap that forms eventually. Let's say there's a fair value gap that forms right here. I'm waiting for an inverse. Say we get an inverse with a breaker structure of this structure right here. CISD/CISD. You get an IVG right here. All the market maker model is, it gives you ideas of where you could target, right? Because now I know if it looks like it could be a potential market maker sell model to this high time frame gap down here, I know that I have room for price to move. And I know that I want lower, right? And I see these relative equal lows or these exact equal lows right here. And so I know I want this to be my first target or maybe my full target, because you just want that low hanging fruit. You just want that piece of the pie rather than, you don't need this whole move down. You don't need that, because you never know if price is going to come back and take your break even and then go lower. You just need a little piece of the pie, right? Because like you can often get something like this. Let's say there's a big gap that it leaves, right? And it respects it, but now it stops you at a break even. So what I would do is I'll get in at this IFVG right here, enter, stop the break even once we take this low. And just imagine these are candlesticks. It's just easier to draw it out with lines, but we stop breaking here, and my full position, I exit at these lows right here, because something like this can happen even though it leaves a big ass fair value gap. Let's say it leaves a big ass fair value gap right here, right? But my entry's up here, my break even, once I take these lows, my break even's up here. It could revisit this area, tap into this IFVG again, but it stops you at a break even though your narrative and your idea was right. You're not gonna make any money because you got greedy and didn't take your profits where you should have. You don't need this whole move. But if you're one of those traders that wants to wait the whole move and doesn't move, stop the break even, then do what you got to do. But my strategy, the way I play it, I just need this little piece of the pie rather than the whole curve. Pause. But yeah, this is basically just a drawing of what a market maker model will look like. Well, that's not on the charts. Now let me see if I can find a good market maker model on the charts. Oh, right here. Okay, so boom. We see right here. So right here is perfect. So we have a higher time frame 1 hour fair value gap. We left these external highs up here. We have a high right here. We have a bunch of liquidity resting above. And obviously price is retracing to this fair value gap and this order block / CISD. So we know this looks like it could potentially be the sell side of the curve in a market maker buy model, because we see that we're tapping into this 1 hour fair value gap. So now we're tapping into this fair value gap. Where's that shit at? So now this is the sell side of the curve, right? But I don't need this whole move up. I don't need to target all the way up here where I originally marked out. It just gives me a framework of where I know price wants to go. And remember, price is fractal, right? Price is fractal. And so I know there'll be market maker models within market maker models because their price is fractal, remember. So now I know the overall model is bullish. I can look for even lower time frame market maker models, even though they won't always be present, and you'll have to just look for longs within the higher time frame. Now, as you can see, I'm in a 5-minute fair value gap, right? And I know the overall model is bullish, so I'm not really too worried about this big void right here. So I see I'm in the middle of a 5-minute fair value gap. So technically, this external liquidity is technically this high is external liquidity within this little cell, this little buy model. And so it just makes a little bit more sense. Let me map it out. So as you can see, this price is rebalancing this fair value gap, right? So now, even though I'm in a bigger market maker buy model, I know I'm gonna I align this lower time frame market maker model with the higher time frame one. So we're tapping into the lower time frame. We see, okay, there's a 5-minute gap. So let me type down to the 1 minute. Let me go down to the 30-second because we're in a 5-minute. So now, as you can see there's even a curve to it. Pause. So we're reaching into this 5-minute gap. I'm looking for longs, right? Let's see if we can get something. I'm gonna get something clean. Okay, perfect. So see, now we formed a gap. Now I know that, like, you could see the curve start to form, right? We have this. What is this? Remember what this is. What is this side in a market maker buy model? This is the sell side of the curve, because the example I showed you, it was the market maker sell model. So it's flipped, sell side of the curve. Even though this is just straight consolidation, but as you can see, it's not always going to look the same. So we have our external liquidity draw right here. External. This is where we're targeting the sell side of the curve right here. And so since you now know market maker models, you know the ultimate price target is here for this within this model, right? So then you map out your fair value gaps to see if anything can get violated. So now we know we're in a 5-minute fair value gap. It's respecting a 5-minute fair value gap. So now I'm looking for longs whenever this gets violated. So we wait for this to get violated. What time is it? Oh, I thought it was a macro. But we wait for this long to activate. Come on, my nigga. Boom, right? So we see some volume to the upside. Not a close yet. Close, bang. Told you. And so then our entry model is targeted. We know that we're in line with the higher time frame market maker model, and then we even have a lower time frame market maker model within, because price is fractal. All these models occur on every time frame. Now I know this is the target. How many contracts do I want to use here? So I'm risking about 15 points. So I'm gonna just go like 9 contracts. Stop. Stop is down here. TP. And then boom. Let's see. And then see, just like that, the curve is prevalent. The curve is obvious right here, right? And what did we just catch? What side? We caught the buy side of the curve, right? This is the buy side of the curve. And as you can see here, there happen to be 2 consolidation points. So we have, the buy side was a little bit cleaner. So we have consolidation right here. It's kind of subjective, but consolidation right here. another form of consolidation, potential for another entry down here. So we have 2 consolidation points on the buy side of the model, and then we targeted this external liquidity, and obviously it was a clean run. And as you could see, the curve, right? You could see the girth and the curve of this model, and then you just made money just like that. This occurs every day on every time frame, and it's so much better when the higher time frame model aligns with the lower time frame model. As you can see, I don't need the whole model, of course, is all the way up here. But if you catch a move that goes along with the lower time frame, it's even cleaner, right? It's like division. I don't even know if that makes sense, but if that makes sense, it makes sense. It's like division, but just models within models within models, right? Like there's probably even a daily that's even bigger. That it's just all, it has to align. Everything moves within alignment within trading. That's why it's an algorithm. And so then I'm sure eventually at one point, I'm not sure if it does, but it should. Come on, bro. Why is it not working? Come on, bro. Give me a good example here. This is overnight, so I'm sure during New York session, price will pick up. Oh, shit. See, this is why you don't trade during news. Because this is when the algorithm doesn't act accordingly, right? We got the nice little market maker model, and then news came and completely dicked your shit, right? Started to look like the buy side of the curve, and then on a normal day without news, usually, this is a good lesson right here. Normal day without news, the algorithm will act accordingly and will run these highs. But since we had news and this bitch ass nigga Trump's in office, even though I'm not saying I don't support him, I do support him. This nigga's in office. There's a bunch of different factors that go into this. This is probably CPI or some shit, so it has nothing probably to do with Trump, but shit like this happens. This is why you don't want to be in the market when there's significant news within the day. Okay, so let's see if we can go catch another market maker model. So boom, right? So we left external liquidity here, and we are respecting this internal liquidity. And so what is our next draw? External. So the overall model is showing us that this should be, hindsight, this should be the sell side of the curve, right? And then we want to catch the buy side of the curve, right? Sell side, buy side. So then that's when we want to find our model to target the external liquidity that it left. This is probably a good move right here on the 5, 3. See, this is where our model formed. But here's our model right here. So we know we're on the sell side of the curve, and so we know that we want to catch the buy side. We know we want to catch this external liquidity, and so we see this is where our entry model is. Boom, boom. We see this right here, rejecting that 1 hour. We have external above. We don't need all this move. So once this triggers is when I enter. We violate this gap. I know I'm on the buy side. I know I want to catch the buy side of the model. So this is a low risk buy, as people will call it. The bottom of the curve, the beginning of the curve, and the original consolidation. Not the original consolidation. The first consolidation is always going to be a low risk buy, right? Because price is always going to tend to go up when you're in the bottom of the buy side of the model. So we have a low risk buy right here. How many contracts is this? How many? So I'll go in with like 5 contracts. Stop the break even once we take that high. So my stop would be the break even. This is about a 1-to-1. So this could even be your target right here. But if you want to target higher, you can target even higher, right? But you don't need that. You don't need all that. I'll probably be out right there. Oh shit. I'll probably be out with there's probably a SMT right here, but you get the point, right? You caught the buy side of the model. As you can see, there's a curve. Right? Boom. You want to catch the buy side after the sell side of the curve. This is the sell side of the curve. Right? You see it. This is the sell side. Let me move it a little bit more. This is the sell side. You want to catch the buy side of the curve. And it just gives you a framework of where to look and what to look for. And this was the end of the trading day, so this would have been a W right here. But you get the point, right? Internal to external, external, internal. Internal to external, external to internal. Let's see what this does. See, boom. And then there's another model. They farm all the time. That's why you don't need to be in a rush to catch plays. We took external, which I'm assuming this is I'm gonna just assume this is SMT right here, or it took on an NQ or something like that. You can see there's even a sell model here because we just took external, right? So we just took external. We're gonna target some sort of internal liquidity. So if, let's say you missed this move. Now it presents you another opportunity because since we just swept external, now I want to target some sort of internal now. Right? So now there's another move, and now it gives you another framework to look and be like, okay, I see there's sell side resting below down here. Let me try to find something in premium. Like for example, we see right here. Okay, let me close this. We see that there's a fair value gap right here. So once this gets violated, I want to target this low right here. So boom, it gets violated. Boom. Now I want to target here because I know the sell side of the model is coming. And it still should be, this is about equilibrium on premium. The IVG is in a premium. Since you guys know premium discount now we just wait for buy side to sell side to be targeted. Patience, patience, patience. Just like that, you just caught the sell side of the model if you missed the buy side. You don't want to get FOMO if you missed the buy side. There should be a sell side coming. You just got to remain patient, locked in. And that was a pretty good video. Oh, also one more thing. Higher time frame, external, internal usually aligns with the lower time frame market maker model. So, like I just said, this is how it works. So it'll be daily, 4 hour, 4 hour, 4 hour to 15 minute. I'm drunk as hell. Wait, I'm tripping. I'm gonna do 4 hour because I don't go above the 4 hours. So 1 hour to 5 minute, 15 minute, 15 minute to 1 minute. And then you could do like 5 minutes to 30 seconds. So these are the alignments of market maker models. So basically what I'm saying here is The fuck? So when we see some sort of 4-hour point of interest targeted, or a 4-hour external to internal, or a 4-hour internal to external. So let's say we see this 4-hour gap. I want to drop down to the 15-minute and look for my model in the 15-minute. Even though it doesn't always necessarily have to be like that, it just gives you sort of a guide of how it aligns. What I like to do is look for 15-minute external internal models or internal external models, and then go down to the 1-minute time frame and then go from there. So if like I just showed you guys a second ago, if we get a 15-minute, let's say right here, right here we see a 15-minute fair value gap. If I see a 15-minute fair value gap as internal liquidity, I would want to see this get tapped into on the 1-minute, and I'll look for sell side of the curve on the 1-minute, and I'll look for the curve, the whole entire model on the 1-minute, because we got a 15-minute fair value gap, and so the model will occur on the 1-minute. And so you want to somewhere get in there, look at fair value gap right here, and then your model will come on the 1-minute. Where did that shit go? But yeah, this is a good reference to have. So if you want to screenshot this, I'll make it a little bit bigger. This is just, make sure you put my face in that shit too. Make sure your girl don't see that shit though. I mean, yeah, screenshot that junk, nigga. Yeah, fuck is you talking about, nigga? Screenshot my face, nigga. But yeah, it's a good reference to have if you're looking at a market maker model. But yeah, good video. Catch y'all niggas later. I hope niggas is still watching this shit. Niggas got no views on this junk, but shit.